Section 3 Risks and Limitations. 3.1 Possibility of premature exits. Stop-loss orders being triggered by short-term price fluctuations is a risk that traders should be aware of. Here are some considerations when evaluating this risk: volatility and market noise. Short-term price fluctuations are often a result of market noise and volatility. These price movements can be random and unpredictable, leading to stop-loss orders being triggered even in the absence of a significant change in the underlying trend or market conditions. Traders should understand that stop-loss orders are designed to protect against adverse price movements, but they can also be susceptible to being triggered by short-term market noise. Setting appropriate stop-loss levels. To mitigate the risk of being stopped out by short-term price fluctuations, traders should set their stop-loss levels strategically. Placing stops too close to the entry price may result in premature exits, while placing them too far away may increase the potential loss and reduce the risk-reward ratio. Traders need to find a balance by considering factors such as volatility, support and resistance levels, and the specific characteristics of the trade, time frame and trading strategy. The time frame and trading strategy employed can impact the likelihood of stop-loss orders being triggered by short-term price fluctuations. Short-term traders who focus on quick price movements and use smaller time frames may experience a higher frequency of stop-outs due to the inherent volatility and noise associated with short-term trading. In contrast, longer-term traders may have wider stop-loss levels to allow for larger price swings and reduce the impact of short-term fluctuations. Consideration of risk tolerance. Risk tolerance is an important factor when evaluating the risk of stop-loss orders being triggered by short-term price fluctuations. Traders with a lower risk tolerance may prefer tighter stop-loss levels to minimize potential losses, even if it means a higher chance of being stopped out. On the other hand, traders with a higher risk tolerance may opt for wider stop-loss levels to give trades more room to breathe and withstand short-term price fluctuations. Technical analysis and indicators. Incorporating technical analysis and indicators into the decision-making process can help reduce the risk of stop-loss orders being triggered by short-term price fluctuations. Technical analysis tools such as trendlines, moving averages, or oscillators can provide additional confirmation and context for setting stop-loss levels. By considering the broader market structure and trend, traders can reduce the likelihood of being stopped out by minor price movements. Monitoring and adjustment. Traders should actively monitor their positions and market conditions to assess if adjustments to stop-loss levels are necessary. As the trade progresses, and if the price moves favorably, traders may consider adjusting their stop-loss orders to lock in profits or trail the stop to protect gains. Regularly reviewing and adjusting stop-loss levels can help adapt to changing market dynamics and minimize the risk of being stopped out by short-term fluctuations. While the risk of stop-loss orders being triggered by short-term price fluctuations exists, it can be managed through careful risk management, strategic placement of stop-loss levels, and consideration of individual trading preferences. Traders should be aware of the inherent uncertainties in the market and adapt their risk management approach accordingly. False stop-outs, where stop-loss orders are triggered by short-term price fluctuations but the underlying trend remains intact, can be frustrating for traders. Here are some strategies to minimize false stop-outs. Use wider stop-loss levels. Setting wider stop-loss levels can provide trades with more breathing room to withstand short-term price fluctuations. By giving trades additional space, traders can reduce the risk of being stopped out prematurely due to minor market noise. However, it's important to strike a balance between wider stop-loss levels and maintaining a favorable risk-reward ratio. Utilize higher time frames. Higher time frames, such as daily or weekly charts, can help filter out short-term price fluctuations and provide a more accurate assessment of the underlying trend. By basing stop-loss levels and trade decisions on higher time frame analysis, traders can reduce the likelihood of being influenced by temporary price movements and avoid unnecessary stop-outs. Incorporate technical indicators. Technical indicators can provide additional confirmation and help filter out false signals. Traders can use indicators such as moving averages, trendlines, or oscillators to assess the strength of the trend and set stop-loss levels accordingly. For example, a trader may place a stop-loss order below a key support level or a moving average to avoid false stop-outs. Monitor market volatility. Volatility plays a significant role in triggering false stop-outs. Monitoring market volatility can help traders assess the appropriate placement of stop-loss levels. During periods of high volatility, wider stop-loss levels may be required to account for larger price swings. Conversely, during low volatility periods, tighter stop-loss levels may be sufficient to protect against minor fluctuations. Combine stop-loss orders with other exit signals. Relying solely on stop-loss orders as the sole exit strategy may increase the risk of false stop-outs. Traders can consider using additional exit signals, such as technical patterns or indicators, to confirm the validity of a potential stop-out. By combining multiple exit signals, traders can reduce the chances of being stopped out by short-term price fluctuations alone. Regularly review and adjust stop-loss levels. Markets are dynamic, and conditions can change over time. Traders should regularly review and adjust their stop-loss levels as the trade progresses and market conditions evolve. If the trade is showing signs of strength or if the underlying trend has become more favorable, traders may consider adjusting the stop-loss level to protect profits or tighten the stop to reduce potential losses. It's important to note that even with these strategies, false stop-outs cannot be completely eliminated. They are an inherent part of trading, and traders should be prepared for occasional losses due to short-term market fluctuations. Implementing a robust risk management strategy, maintaining discipline, and focusing on the long-term trend can help traders minimize the impact of false stop-outs and improve overall trading performance. 3.2 Market volatility and slippage. Market volatility and slippage can have a significant impact on the execution of stop-loss orders. Here's how these factors can affect stop-loss order execution. Market volatility. Volatility refers to the magnitude and frequency of price movements in the market. During periods of high volatility, prices can change rapidly, and market orders, including stop-loss orders, may be executed at prices different from the expected stop price. This is known as slippage, positive slippage. In some cases, high volatility can result in positive slippage, where the stop-loss order is executed at a better price than the specified stop price. This can occur when there is a sudden price gap in favor of the trade, and the order gets filled at a more favorable level. Positive slippage can benefit traders by reducing potential losses or increasing potential profits. Negative slippage, on the other hand, negative slippage can occur when market volatility causes prices to move rapidly, resulting in the execution of a stop-loss order at a worse price than the intended stop price. This can happen during fast market conditions, news releases, or when liquidity is low. Negative slippage can lead to larger losses than anticipated. Order execution speed and liquidity. The speed at which an order is executed can also be influenced by market volatility. During highly volatile periods, order execution may be delayed, and there may be a higher likelihood of slippage. This delay can be due to increased order volumes, reduced liquidity, or technological limitations. Traders should be aware that their stop-loss orders may not be executed instantaneously during periods of high volatility, and there could be a time delay between the trigger price and the actual execution. Order book depth. The depth of the order book, which represents the number of buy and sell orders at different price levels, can impact the execution of stop-loss orders. During high volatility, the order book may have fewer orders at certain price levels, leading to larger price gaps between the bid and ask prices. This can increase the likelihood of slippage as the market quickly moves through these price levels. Broker execution policies. Different brokers may have varying execution policies and practices when it comes to stop-loss orders. Some brokers may prioritize executing stop-loss orders at the specified stop price, while others may prioritize speed of execution, potentially leading to more slippage. Traders should be familiar with their broker's execution policies and understand how they handle stop-loss orders in different market conditions. To mitigate the impact of market volatility and slippage on stop-loss order execution, traders can consider the following measures: adjusting stop-loss levels, taking into account market volatility. Traders can set stop-loss levels that allow for a reasonable amount of price movement while still protecting against excessive losses, using limit orders. Limit orders can be used instead of market orders for stop-loss orders. Limit orders allow traders to specify the maximum price at which they are willing to exit the trade. However, it's important to note that limit orders may not guarantee execution if the market price quickly surpasses the specified limit price. Monitoring market conditions. being aware of market conditions, news events, and volatility levels can help traders anticipate potential slippage and adjust their trading strategies and risk management accordingly. Diversification and risk management. Diversifying a trading portfolio across different instruments and using proper risk management techniques can help mitigate the impact of individual trades experiencing slippage or adverse market conditions. Traders should regularly evaluate the execution quality of their stop-loss orders, monitor slippage occurrences, and adapt their strategies as needed to optimize the execution of their trades in different market conditions. To mitigate the impact of volatility and slippage on stop-loss orders, traders can employ several techniques. Here are some strategies to consider. Use limit orders for stop-loss orders. Instead of using market orders, which are executed at the prevailing market price, traders can use limit orders for stop-loss orders. A limit order specifies the maximum price, for a long position, or the minimum price, for a short position, at which the trader is willing to exit the trade. By using limit orders, traders have more control over the execution price and reduce the risk of slippage. However, it's important to note that limit orders may not guarantee execution if the specified price is not reached. Consider using stop limit orders. A stop limit order combines the features of a stop-loss order and a limit order. It consists of a stop price and a limit price. When the stop price is reached, the order is triggered, but it is only executed at the specified limit price or better. Stop limit orders can help mitigate the risk of slippage and provide more precise control over the execution price. However, there is a possibility of the order not being filled if the market does not reach the limit price. Set realistic stop-loss levels. It's essential to set stop-loss levels that consider the inherent volatility of the market and the specific instrument being traded. Setting stop-loss levels too close to the entry price increases the likelihood of being stopped out by normal price fluctuations, while setting them too far away may expose the trade to larger potential losses. Traders should conduct technical analysis, consider support and resistance levels, and assess market volatility to determine appropriate stop-loss levels. Adapt stop-loss levels to market conditions. Market conditions can change over time, leading to fluctuations in volatility. Traders should regularly monitor and adjust their stop-loss levels based on the prevailing market conditions. During periods of high volatility, wider stop-loss levels may be necessary to account for larger price swings, while tighter stop-loss levels may be sufficient during periods of low volatility. Implement trailing stop-loss orders. Trailing stop-loss orders can be used to lock in profits while still allowing for potential further upside. A trailing stop-loss order is set at a specific percentage or amount below the highest price reached since the trade was initiated. As the price moves in the trader's favor, the trailing stop-loss order automatically adjusts upward, maintaining a specified distance from the highest price. This technique allows traders to protect profits while giving the trade room to potentially capture larger price moves. Monitor news and economic events. News releases and economic events can significantly impact market volatility. It's important to stay informed about upcoming events that could increase market volatility and potentially trigger slippage. Traders can adjust their trading strategy, position size, or temporarily suspend trading during periods of expected high volatility. Choose reputable brokers with good execution practices. Different brokers have varying execution practices, including their handling of stop-loss orders during volatile market conditions. Traders should select brokers with a good reputation for reliable order execution, low slippage, and transparent execution policies. Researching and comparing brokerages can help find a broker that aligns with specific trading needs. Test and optimize strategies. Traders should thoroughly backtest their trading strategies using historical data to assess the impact of volatility and slippage. By simulating different market conditions and analyzing the performance of stop-loss orders, traders can identify potential areas of improvement and optimize their strategies to better handle volatility and reduce slippage. It's important to note that while these techniques can help mitigate the impact of volatility and slippage, they cannot completely eliminate the risk. Traders should always be prepared for unexpected market movements and employ proper risk management practices to protect their capital. 3.3 Over-reliance on stop-loss orders. While stop-loss orders are a valuable risk management tool, it is important to complement them with other risk management strategies. Relying solely on stop-loss orders may not provide comprehensive protection against all potential risks. Here are some complementary risk management strategies to consider. Position sizing. Proper position sizing is crucial to manage risk effectively. By allocating a reasonable portion of capital to each trade, traders can limit the potential loss per trade. Position sizing techniques, such as fixed dollar amount or percentage-based risk, help ensure that no single trade has the potential to significantly impact the overall trading account. Diversification. Diversifying a trading portfolio across different instruments, sectors, or markets can help spread risk and reduce the impact of individual trades. By diversifying, traders avoid overexposure to a single asset or market, which can help mitigate losses if one trade or sector performs poorly. Diversification can be achieved by trading multiple assets, using different trading strategies, or considering non-correlated assets. Risk-reward ratio assessment. Evaluating the risk-reward ratio before entering a trade helps ensure that potential profits justify the potential loss. A positive risk-reward ratio means that the potential reward is greater than the potential risk, providing a buffer against losing trades. Traders can set a minimum risk-reward ratio that meets their trading criteria and only take trades that offer favorable risk-reward profiles. Trailing stops. Trailing stops allow traders to lock in profits as the trade moves in their favor. By adjusting the stop-loss level as the price advances, traders protect their gains and secure a portion of profits. Trailing stops help capture larger price moves while still providing protection against adverse price reversals. Risk assessment and analysis. Continuous risk assessment is essential in trading. Traders should regularly evaluate and analyze the risk factors associated with their trades, such as market conditions, news events, and technical indicators. By staying informed and aware of potential risks, traders can make informed decisions and adjust their risk management strategies accordingly. Continuous learning and improvement. Developing trading skills and knowledge is a critical aspect of effective risk management. Traders should invest time in learning about different trading strategies, risk management techniques, and market dynamics. Continuous education, attending seminars, reading books, and analyzing trading performance can help refine risk management strategies and improve overall trading outcomes. Emotional discipline. Emotional discipline is crucial in risk management. Traders should adhere to their risk management plan and avoid making impulsive decisions based on emotions such as fear or greed. Following a disciplined approach and maintaining emotional control can help avoid excessive risk-taking and protect capital. Combining these complementary risk management strategies with stop-loss orders helps create a comprehensive risk management framework. Each strategy serves a specific purpose and collectively contributes to overall risk mitigation. By diversifying risk across multiple strategies, traders increase their chances of protecting capital, minimizing losses, and improving long-term trading success, while stop-loss orders are an essential tool for risk management. Relying solely on them has certain limitations. It is important to be aware of these limitations to develop a comprehensive risk mitigation strategy. Here are some key limitations of relying solely on stop-loss orders. Execution risk. Stop-loss orders are executed at the best available market price after the specified stop price is reached. However, in fast-moving markets or during periods of low liquidity, the execution price may deviate significantly from the stop price, resulting in slippage. This means the trader may experience larger losses than anticipated if the market gaps through the stop price. Slippage can occur even with the use of limit orders for stop-loss orders but may be reduced compared to market orders. Market gaps and price spikes. Stop-loss orders do not guarantee protection against market gaps or price spikes. In volatile markets or during news releases, the price can move rapidly and bypass the stop-loss level, resulting in a significant loss beyond the intended risk level. This can occur when the market opens with a gap due to overnight news or when there is a sudden surge in volatility. Traders should be prepared for such events and consider additional risk mitigation measures. Market manipulation. Stop-loss orders can be targeted by market manipulators. In certain scenarios, traders with large positions or market influence can intentionally trigger stop-loss orders by briefly driving the price to the level where these orders are concentrated. This can result in a cascade of stop-loss orders being executed, leading to market volatility and potentially causing losses for traders relying solely on these orders. False breakouts and market noise. markets can experience false breakouts or temporary price movements that do not reflect the underlying trend. Stop-loss orders placed near support or resistance levels may be triggered by these short-term price fluctuations, resulting in premature exits from trades. Traders need to consider market noise and use additional tools such as technical analysis or confirmation indicators to avoid being stopped out by temporary price movements. Over-reliance on mechanical exits, relying solely on stop-loss orders may lead to mechanical and rigid trading decisions. Market conditions can change, and sometimes it may be beneficial to adjust the exit strategy based on new information or evolving price action. Strictly adhering to stop-loss levels without considering other factors or adjusting the strategy accordingly may result in missed opportunities or unnecessary losses. Limitations in highly volatile markets. In extremely volatile markets, stop-loss orders may not be the most effective risk mitigation tool. Wide price swings, high volatility, and rapid price fluctuations can make it challenging for stop-loss orders to provide adequate protection. During such periods, alternative risk management strategies like reducing position sizes, hedging, or temporarily stepping aside from the market may be more appropriate. To overcome these limitations, traders should consider incorporating complementary risk management strategies, as discussed earlier, and continuously assess and adapt their risk management approach based on market conditions. Employing a combination of techniques, including diversification, position sizing, trailing stops, and regular risk assessment, can help enhance risk mitigation efforts beyond relying solely on stop-loss orders.